Greetings, everyone. Hopefully there's 1,000 of you out there. I can't see the numbers currently, but we had about 65 signed up yesterday afternoon. I'm going to give it a few more minutes to let people show up. Usually we get a full crowd like 5-6 minutes after the hour. So I'm going to wait just a few more minutes if you don't mind. Hope everybody's doing well today. It's raining in Nashville, Tennessee. Again, allergies are terrible this year. Blooms are brilliant. That's the good news. More Californians are moving here by the minute. That's the bad news. They're tax refugees, of course. And I guess you could say we're the beneficiaries of all the traffic. And here we are. I'm going to give it just a couple more minutes. Again, welcoming everyone to the webinar. We're going to talk. Everyone's wondering, I'm sure, what this picture is about. Like, what is Jerome Powell referring to with his hand gesture? A few of you are actually kind of sick. That is not what he's referring to. Goodness, you're sick. He's actually referring to the presidential attention span of the last couple of presidents, including the current one. Maybe that's what he's referring to. Or maybe he's referring to Janet Yellen's height. Could be referring to that. But the truth is, I believe he's referring to his tolerance for a equity market sell-off or a capital market or any capital market weakness whatsoever. That's what he's referring to with his gesture. Okay, so I'm going to start now. We're about 5 minutes, 3 minutes. I'm going to go ahead and start. I'll always start with something. My son and Chief Operating Officer of our business is my technical expert. This is how I upload files to the cloud. So I want to introduce him because I'm often yelling for him in the middle of this in these webinars. So I'm going to go ahead and introduce my son, number one son, Faxland Street.
Hello, everyone.
So you'll know that we won't have any technical glitches now that he's here. Full disclosure, neither party has a monopoly on bad ideas. We're equal opportunity haters. In regard to the politics, we have to talk about politics because we focus a lot on policy. And what is policy without politics? Anyway, the information presented here is not meant to be investment advice. It's supposed to be edutainment. It's supposed to be entertaining and educational, obviously. So Jerome Powell is the focus of some of the webinar today. He's had a busy week. Fed leaders, governors, and Powell himself have had 8 speeches or given 8 speeches this week, which I think they're just trying to convince the world of their lasting, everlasting dovishness. And they're doing that in the same week where we have a huge series of treasury auctions. One of them was today. And I will go through that. A record amount of treasury debt is maturing this year, which means that the Federal Reserve has to actually issue new debt. And the Treasury does, the Treasury has to issue new debt. This is today's S&P action. The market started off rather weak. It started gapping down. I don't know if you can see my cursor, but it started gapping down until exactly 11 o'clock. And that's when the auction opened for the mammoth 7-year Treasury bond auction today. So I'm a conspiracy theorist only in a few things. One of them is that we are living under the most manipulative Federal Reserve and I think government regime, at least in my lifetime. And they very much believe in the psychological aspect to investing. They call it behavioral psychology. Ben Bernanke did his thesis on this one. It's how the Fed and authorities can manipulate sentiment to protect the economy and the market from a downturn in the markets, capital markets. And they use these tools to, again, protect us from ourselves. And it's ironic that at 11 a.m. today, the S&P stopped its downward trajectory, formed a bottom quickly, and started marching upwards right at the time that they are holding one of the largest 7-year Treasury auctions in many, many years. And I do believe it's not by chance. It is absolutely planned. Why do I believe this? Well, among other things, I've showed this chart before. This is a chart that shows after hours trading performance of the S&P relative to U.S. daylight trading hours. The blue line being the performance of the S&P after the market closes, the light blue line that is, the dark blue line being the performance of the S&P during trading hours. What is going on there? Manipulation. The Fed ownership of treasuries, once again, is through the roof as they continue to buy $120 billion worth of treasury securities and mortgage-backed securities per month. And my guess is, gang, before the year's over, they'll pick that up substantially. And it'll be a bit of a shocker. And I want you to remember I said it. Here is the Fed's balance sheet, and it'll expand more during the coming cycle and the current cycle than it did during QE 1, 2, and 3 combined. So there's the Fed balance sheet. That's the Fed buying treasuries and other assets and pushing money out into the capital markets, which is, of course, driving our ebullient market that pretty much is, how do I say, impervious to risk. Here's foreign ownership of treasuries, declining rapidly. And so the Fed's buying all the supply. Foreigners have reduced their ownership and their purchases and significantly, Japan included, our ally, but it's throughout the Asian nations very significantly. The only thing in plentiful supply in our economy right now is treasury debt. You know that there are shortages of a lot of products, including, for instance, new cars, used cars, housing, lumber. I'll go through that. The only thing in plentiful supply is treasury debt. And this shows that $5.8 trillion worth of treasury debt is maturing this year, which is by far a record. And that means it has to be refinanced. So that means all those treasury bills that I mentioned that they're going to be auctioning is at record levels. So it's unprecedented. I believe the Fed will have to step in to buy in a big way. Today's, by the way, 7-year auction did not go that well, apparently, from what I hear. This just in. Here's federal government deficit as a percent of GDP. That's projected, of course, going the sloping upward curve. We'll end this year with a $5 trillion annual budget deficit. $5 trillion at least, especially if they pass the $3 trillion infrastructure spending bill. That, of course, includes the $1.9 trillion so-called stimulus bill, much of which goes to unproductive purposes. In fact, all of it does. And by the way, government policies like these, the bailout, stimulus, doesn't add to GDP, gross domestic product. It rearranges it. In this case, they're going to be giving money to individuals for something other than work effort. Okay, there's friction there. And those people, what they hope is those people will go out and buy stuff. What it does is pull forward demand. And it pulls forward demand out of future demand. And future demand, they're penalizing with an extraordinarily heavy deficit and debt burden. That will be a dead weight on GDP growth in the United States for generations to come, because this debt is unprecedented in our lifetimes and beyond. So once again, the stimulus package, giving money, free money to people for something other than work effort, does nothing but rearrange GDP by pulling forward demand and taking demand away from the future. And the way, again, is the way they take demand away from the future, again, is through the debt and deficits, burdening our productive economy. So if you're a supply sider, you know that demand does not come before supply. Supply comes before demand. For without production, you cannot have the wealth necessary to demand goods and services. That's the supply side view, which I ascribe to. Governments around the world are loading up on debt. Here it is. Startling. And I didn't even mention the unfunded obligations of Social Security. And it's as 10,000 baby boomers retire and turn Social Security retirement age per day now, the demands on our future production are going to be much bigger than the on balance sheet demands that we saw just then with the deficit. Pretty sobering. Corporate balance sheets are in terrible shape. I've said many times that 65% of NASDAQ constituents have junk bond rated debt, a record. Junk bond is just as it sounds, junk, not creditworthy. And zombie firms are at a record. Those are companies that don't generate the requisite cash flows to actually service their debt. So corporate America is really in a bind. The 2008, the market since 2008, the great financial crisis, GFC, has increased significantly, 350% or something, but profits have really gone nowhere during that period of time. The green line at the bottom is corporate profits, and then the other two lines are the 12-month forward PE and earnings per share. The black line, the dotted line being earnings per share, excuse me, the brown line being price, and then the forward PE being the dark solid line. So again, it's been multiple expansion driven by Fed large S, money printing, period, QE 1, 2, 3, Operation Twist, ZERP, zero interest rate policies, ZERP. And then there's more to come. Zombie companies, this is just the share of publicly traded companies that are zombies, very high. Now we're seeing IPOs of zero revenue companies at greater than $1 billion just this year. And these are SPACs. We call it speculation at the office. These are companies that are, in many cases, I've heard, these SPACs that raise money in a shell, blank check company, are buying other companies, private companies, literally from the doorstep of bankruptcy court. I know of several instances where that is absolutely the case, and numerous other ones where I've known technology companies bouncing around the Silicon Valley for 10 years, unable to get anywhere really. And then here comes a SPAC to save them. So the SEC, by the way, is vowing to look into SPACs and their lack of disclosure. As you know, in an IPOs, they have what's called an S1, and it's this prospectus. In that prospectus is a disclosure page or two. And if you read those disclosures, you'll never buy the stock, by the way. They're scary. They include everything. And then SPACs don't have these disclosures at all. They talk about a total addressable market, TAM, which I'm sick of hearing about. And then the fact that they're going to get 10% of the TAM, and the TAM is infinity, and they're going to get 10% of infinity, and so buy the stock. And that's as far as they go in their pitch, in their income statement comments, etc. That game is over, gang. The SPAC window is slamming shut, in my opinion. This market's at risk. I'll go through that. This is what happens when a country slows its stimulus. China, too, by the way, has been stimulating their economy significantly through money printing and debt creation and lending throughout the economy. And the kind of purple or plum line there is China index. And they have been pulling back on their largesse, on their generosity, and their stock market's taken a beating. By the way, Hong Kong is too. So this is what the Fed is facing, right? If they pull back at all on the money printing, we'll see a decline in the market because it's a bubble and it's inflated every day by the huffing and puffing of the Federal Reserve's money printing. And I mentioned to you earlier, 120 billion a month in both treasuries and mortgage-backed securities. So when you see the picture of Fed Chairman Powell going like this, it is literally his tolerance for that. A market decline driven by a decline in liquidity, which will be driven by his not huffing and puffing to blowing up the bubble, if that makes sense. Now, I'm going to get to a new topic called inflation, because with all the money printing and all the largesse and the fiscal and monetary stimulus, we're starting to see something we haven't seen in some time. Question is going to be really interesting if it's permanent or if it's temporary. Most people will tell you it's transitory. Those same people told you it was not possible a month ago, but we have it already. I'm going to go through it. Inflation, the Milton Friedman definition, is too much money chasing too few goods, or he certainly made that phrase famous. And we know where we got the too much money, right? I've just been through the chart showing the money printing. And of course, we know about the STEMI checks. But how do you get too few goods? And in the 70s, we got it under Richard Nixon's presidency. Remember, I said neither party has a monopoly on bad ideas. Well, Richard Nixon was one of the worst. His wage and price controls led to a decline in the amount of goods and services available to the market, and prices increased significantly amidst money printing by Bill Miller, the Fed chairman. But specifically, it was his wellhead price controls. That is, the United States was by far the largest oil producer in the world at the time. Most oil came from literally Texas, Oklahoma, and Alaska. Afraid of a broad inflationary like drift, Nixon, in his wisdom, placed a price control on what U.S. producers could charge per barrel of oil, by the way, below the prevailing market price. So if we were all oil producers and we were met with a regulation that required that we charge less than the market price for our product, what are we going to do? Well, production declined for 40 years after that decision. So again, neither party has a monopoly on bad ideas. I'll pick on both parties equally and with equal delight. The too few goods here is a real issue, and it may be a lasting one. In this case, M2 money supply is outpacing inflation. You can see here the CPI is a bogus, by the way, a terribly bogus stat, which I can answer in Q&A if you're interested. The blue line is money supply, M2 money supply. The lighter blue line is the CPI. You can see where the blue line leads the light blue line. In other words, money supply through the years has always led inflation. And to my far right, you can see where money supply is through the roof, but inflation, at least according to CPI, has been falling lately. We'll see if CPI, which I'll tell you is a manipulated statistic, is going to reflect the real price inflation that we're seeing. I'll show you some components right now. So this is where we get too few goods. How about this one? This is backlog of work, where we have an increase in demand, but for some reason or another, we don't have the supply of raw materials, or there's let's say a interruption in the supply of those goods. So this is a growing backlogs of production. Here is delivery time. So a lower number here means longer delivery times. So there's been obviously a major interruption in the supply chain driven by COVID, and probably the legacy effect of some of the tariffs, and the fact that U.S. producers have started to try to bring some of their production back to the West and to the United States, which is, of course, redundant, but nonetheless, might be necessary, but it's happening. Here, input prices are soaring. This is market U.S. services PMI, which is showing input prices rising very aggressively, and then prices charged rising very aggressively. These are for services, like probably a lot of restaurants in here, honestly, food service, but dry cleaners. And by the way, this also is the largest employer out there. Something like 70% of our citizens are employed by service businesses. So I would expect to see an increase in the price of goods because of the disruption and interruption in supply chains and materials availability. But in the service sector, I'm a little bit shocked at this. And by the way, I'll tell you why, one of the reasons. And then output prices, this is manufacturing output. So this is the goods part. The last two charts were of services. So output prices are extremely high and rising. So there you are, gang. That's inflation where I come from. I'm going to go into something really interesting I'm asked about all the time, and it's the definition, or what is going on with the GameStop fiasco, if you will, the phenomenon. Everyone must be aware that GameStop was a heavily shorted stock that became a target of Robinhood retail investors, mostly of the millennial kind of age group, that basically gang tackled the shorts that were weighing on GameStop and led to the increase of a marginal company thousands and thousands of percent. The stock price rallied, and it's been literally like a lightning rod for emotion ever since. It's evolved even into a class warfare story, which is typical America, by the way, modern America, where we're all pitted against each other based on race and class and gender and color. I've never seen anything like it in my life. And that's another webinar, but I'm very, very sad about it. Back to GameStop. A fractal is a freak accident in my view. And that's what we have here. It's a confluence of influences that have led to this crazy event, and I'm going to go through it. It starts with free money directly from the printer. That is the Fed. I went through the money supply numbers and how much the Fed's been printing and then buying securities, inflating the capital markets. This is free money. It were a number of different things, all free, that were all available to these investors at once, that led to the opportunity to storm the GameStop shorts. That's what I'm trying to get at. Without free money from the Fed and inflated asset prices, it couldn't have happened. This is a picture of margin debt, by the way, at all-time record currently. This is retail margin debt. You know what that is. Oh, by the way, isn't that interesting that you got retail margin debt at all-time highs while corporate debt is at all-time highs, while government debt is at all-time highs, while Federal Reserve balance sheets at all-time highs? Do you think it's related? I do. Surprise. So once again, it was free money plus free time, which is the lockdown. Basically, a lot of young people stayed at home. College students no longer didn't return to college. They all stayed at home. Young workers were working from home. There was excess time. And with that free time and free money, they got busy investing in stocks. And without free research, which is influencers on Twitter and Reddit, Wall Street Bets, I'm sure you know Reddit is a site for, like Twitter, for people to express their opinions related to various topics, but it's got a very lively investment audience there that follow these so-called influencers. This just shows how many new users joined subreddit overnight. So again, without free money, free time, and free research, the GameStop fiasco couldn't have happened. And free trading. As you know, frictionless trading has been a big driver of the new investment population, the young people, the millennials joining the investment community. This is daily average trading volume and the size of the trade from retail investors, specifically through online brokers that are now offering free trading. And then finally, free and easy profits. This is a little stale, but this is a survey among people, retail investors, that basically shows that they're going to put a fair amount of their stimulus checks into the stock market, stimmy checks into the stock market. In our office, the young people are adamant that this money is going to go into hot stocks. And I'm telling them, unless if the market's not going up, it won't go in there. If the market's going down, it will not go in there. And in fact, that margin debt will end up being an issue. This money only goes into the market if the market's going up. I promise you that. So I wouldn't doubt it if the Fed didn't know that, and they're going to manipulate the market higher. I know I'm a conspiracy theorist. Not only was GameStop the lightning rod, but many times, and I've been through this before on these webinars, they would input the wrong ticker. One time, Elon Musk, who has tens of millions of followers, mostly among young people, tweeted for all his followers to get on Signal. Signal is a new app, which is supposed to be secure from the NSA, and you can download it and communicate freely and safely by both text and voice. So he's telling everyone to get on Signal. Well, the investment community misread it and went out and bought a stock called Signal Alliance, SIGN is the ticker, I believe. And the stock went up 300 or 400% in a minute. And once they realized he meant Signal, the app, which wasn't a stock at all, it collapsed. Well, here, somebody tweeted or put on Reddit, or excuse me, Wall Street Bets, that Bed Bath and Beyond was heavily shorted, like GameStop. And so they rated everything with a similar ticker. So Bed Bath and Beyond was the target, but these other stocks with similar tickers rallied hundreds of percent as well. So that shows how discriminating these new investors are, gang, how they do their homework. And I'm very proud of them for their efforts. All that activity, by the way, speculation among retail investors amidst one of the worst unemployment levels in my lifetime, if not the worst. There's actually 18 million people now receiving weekly unemployment checks. So the jobs numbers you're seeing do not reflect the nearly 20 million people receiving weekly unemployment checks. They're paying people not to work. There's friction to that in several ways. One, the debt creation. Two, it incentivizes people literally not to work. So when I said inflation is too much money chasing too few goods, this is one of the ways we get too few goods. We don't have the workers that are eager and willing to work and produce and make up for that backlog I went over earlier of products. This is a big issue. It's going to be like the issue in the labor markets. Now, here's something I'm really worried about. Remember, neither party has a monopoly on bad ideas. Joe Biden is ambitious. It's either him or it's his puppet masters, because I don't believe that he honestly has the mental capacity to dream up these ambitious plans, nor the energy to try to enact them personally. I like him personally, by the way, but I think that I've got an aging mother. I think that somebody else is coming up with these ideas. Apparently, he called some presidential historians into the White House to discuss with him history, presidential history, to tell them that he was being ambitious like some of the most ambitious presidents in our history, and asking them their thoughts regarding that, how he might go down in history perhaps, or what are his parameters? Like, what did LBJ do during the Great Society? Or what did FDR do during the New Deal? I'm a student of those two periods, by the way. And I would recommend you read two books by the same author. Amity Shlaes, Schleas, wrote a book about the Great Depression called The Forgotten Man. It's absolutely the book to read about the policy errors that made the Depression deeper and longer than it ordinarily would have been. And then her book called The Great Society, about LBJ's ambitious Great Society effort to eradicate poverty. Both tremendously ambitious presidents and programs, both devastating to the real economy. This very much scares me. My job in analyzing government policies and their incentive effects on behavior in the economy and prices, therefore, has made me a bit of a cynic when it comes to government policies. As I told you before, they rarely add to GDP, but they do certainly rearrange it. And when an ambitious piece of legislation emerges from a senator's office or maybe even the White House, by the time it becomes legislation or regulation, it's been massaged by vested interests, lobbyists, the moneyed class. And it always ends up doing the same thing, protecting the entrenched and the connected and hurting the rest of us. So this scares me. I'll give him a compliment, though, for something else. There is good news from this administration. And it's something that I've been interested in for a while. I've been worried that the Democrats' goal, well, let's just put it this way. If I were to wave a magic wand and make it so the Democrats dream of every American having an electric car, If I could wave a magic wand and make that a reality, we would not be able to generate enough electricity to get those cars out of the garage. You simply cannot generate the required amount of energy with wind and solar. And if you're not going to use coal, which they obviously don't want to do, I have no comment on that, we're screwed. Well, with that backdrop, this administration is doing something very interesting. He's turned a kind eye to nuclear, which has come a long way, by the way, technology that is. And only a Democrat could get away with this. If a Republican or Donald Trump ever came up with something like this, they would kneecap him. And I say they by the environmental, interest groups. But this, I don't even want to tell you, because you'll go tell someone else, and you'll get a negative reaction from the opponents of this. So I want to keep it a secret. Currently, it's not getting any attention. It's because it's Biden. And thank you for that, Joe Biden. The nuclear industry is getting a real, lift. Regulatory winds have shifted. He recently, or the White House has recently extended licenses for 2 reactors that were due to expire. The licenses were due to expire soon, and he's extended them. And now he's actually seeking to extend the licenses for another 100 years. In other words, some of these plants were going to have to be mothballed, and he has just basically postponed the mothballing of these plants. In other words, we need base power. Base power is what coal provides. It's not vague like wind and sun, where you don't get power if the wind doesn't blow and the sun doesn't shine. Base power, like a coal plant, it really is just a giant, coal pile glowing red consistently, evenly, without interruption. They call that base power. The best form of base power is from nuclear. And it's the cheapest and zero carbon emissions. Zero. Our zero carbon world is right here. Every American could have an electric car or 2. And they could also operate their margarita blender, which is really all I care about. So this is a big deal. I'll go through what's cool. At the bottom bullet point, you'll see that they've approved some spending towards evaluating what they call small nuclear reactors, SMRs. These are amazing, okay? They are cheaper, they're smaller, they're more efficient, they're less risky. They make them in a factory and deliver them on site. So they're small and they're powerful, and they provide base load electricity with zero carbon emissions anywhere. Even the military is procuring these devices small enough to where they're almost like a giant battery. They've literally been funding research and developing nuclear batteries that last 3 years without recharging, without fuel. How cool is that? Renewables won't cut it. That's what I was saying earlier. And this is just, electric vehicle adoption, base case, battery and hybrids. And it shows United States and the European Union and China. And the European Union, of course, has very strict mandates. Ours are less strict and only at the state level. China's got an issue if you've been there. I haven't, but I certainly hear them from my friends. It's just so nasty. Your eyes burned when you're there. So they really have a pressing issue. And they've got to deal with it. And they're using nuclear to do that. Asia is basically building something. China, let's see, there's something like 50 power plants under construction currently in Asia, something like that. And so they're basically going to reduce their carbon footprint. This is the best news for the environment that I've heard ever. Perhaps it's terrific. I'm very excited. And there's some stocks to invest in, by the way, as well, which I can hit on the Q&A if you care. This is a very new scale as a private company, but they've designed and build these small modular reactors. And again, they build them in a factory and they ship them on site. So there's a company, well, I'll tell you later if you care, you can ask me in the Q&A. I'm going to go to, what is a bright spot in the economy, and it's the, housing sector. Yes, we have rising prices. That's true, significantly. But And we don't have enough supply. And it's amazing that during COVID, it's like all of America decided to do something at once. No, two things at once. They decided to move out of the city and go to the suburbs in the country. Boom. Millions of Americans with money just took off from California, Illinois, New York, specifically, New Jersey. The states with high income tax rates and heavy regulation, they're tax refugees. And it's like bigger than the caravans, covered wagons that fanned out across the West during the mid 1800s. This is bigger. They're coming from the cities of California, again, and then New England to Austin, Florida, of course, and our fabulous city of Nashville, Tennessee. So we have 30-year fixed rate mortgage at all-time lows. This is the Case-Shiller Home Price Index. That is the dot-bomb era. Remember when the bubble burst in 2000, a bubble formed in housing, and it started immediately after the crash of 2001, and of course culminated in 2008. And of course, that was the federal government fueled as well. But look, Case-Shiller home price is higher than that. It's recovered nicely. Existing home sales, I just have that red arrow there back to 2000, was rising very quickly, but now supply is constraining it. Prices rising has led to, a dearth of product out there. So if I sold my house, which is doubled in value, where do I go? Well, for the same price, I would move to a cracker box. So what do? I won't sell. I would have to go to a third world country, like Alabama or something. I'm kidding, I'm joking. I got friends from Alabama on the call. Sorry. This is household balance sheets, very healthy. Household balance sheets have absolutely repaired themselves since the GFC, great financial crisis, the 08 housing bubble bursting. And remember, though, the households are in good shape. We have a 30-year mortgage rate that is very low. We have this mass migration. My guess is that the residential real estate business and related industries, including home building, are going to be very good shape for a while to go. So one pocket of strength that I like in the economy and in the markets. I just wanted to remind you of a chart I had earlier. This is corporate balance sheets. So while America has delevered at the household level, the government and corporations have not. What's interesting that even though our balance sheets are high, cash levels are high on corporate balance sheets, residential balance sheets, they're still going to throw us trillions of dollars of money to what? To do what? I'll bet you anything. They expect a money multiplier, the Keynesian multiplier, where for every dollar given to you, the citizenry, magically turns into $2.3. That's their number. They can measure it to the decimal point. They really believe that. They believe that you'll get $1. Actually, I don't get any STEMI money. My kids do. They'll get $1 and they'll run out and spend it. They'll spend that $1 where? And my kids, they'll probably do it at the liquor store. But your kids are better. They'll probably go to the hardware store somewhere wholesome, maybe the Whole Foods store. And they'll spend that $1, and the purveyor of that establishment will take that $1 and go spend it wherever he or she spends their money. And then that purveyor will go and spend their money somewhere, and it magically snowballs from $1 to 2.3. That's the equation. They argued for that when they gave almost $1 trillion to people for something other than work effort in 2008 and 9, when they passed that giant stimulus package. All the way, by the way, it pales compared to today's. Less than half. But the multiplier didn't happen. What happened is that $1 didn't turn into $2.3. I actually got in a debate in a big group meeting of like 60 people with Jared Bernstein. You know who that is? He was Vice President Gore's chief economist at the time. I mocked the 2.3 multiplier, said it was going to be a divider. Well, guess what it was? People didn't go spend that money, and it didn't snowball and magically increase every $1 to 2.3. They actually saved a lot of that money. So there was not a money multiplier, but a divider. And that'll happen again. Watch. Now, there's much debate about STEMIs, so we'll go into that too. Corporate balance sheets, I just went over that. Oh, yeah, and this is my disclaimer. But let me go back to something while I'm on it, STEMIs. Stimmies. Where are you, Stimmies? I had, forgive me. I had a survey. Oh, there we are. This shows, again, it's a poll of retail investors asking them how much of their stimmy check would go into the stock market. And I want to repeat, if the market's not up, this money ain't going into the market. So that multiplier that I just talked about will be a divider. That's all I wanted to do. So that's it. This is my disclaimer here. Just to let you know, this is required. Trustco is a RIA, registered investment advisor. We manage money for families, entrepreneurs mostly. Most of our clients have sold a company, to tell you the truth, and then foundations. And George Smith, my childhood friend, good friend, partner, runs that business so well. And then we have several products that are specialty products. I run a hedge fund, for instance, and then we have some commodities oriented and precious metals specific investment funds. So I've got some Q&A here. So I'd like to go ahead and you can reach us by way of those emails right there, by the way. And we have Q&A. So fire up the questions, gang. We have some time left and I'm feeling motivated. The first question is, excellent broadcast. Wait, that's not a question. That's a lie. Kidding. What are some of the nuclear stocks? You have to invest with us. Darn it. No, CCJ is a Cameco, they call it. It's a miner of uranium. They own the largest and cheapest resource in the world in Canada, which is a uranium mine. And I think the demand for uranium is going to pick up it is already picking up for the first time. They had a significant, I'd say, oversupply of uranium, and that's been worked down. So now they're going to probably start reopening mines because the demand's growing. And with the technology advancement of the small nuclear reactors, small modular reactors, this is cool. Oh, another name is, ticker is BWXT, and they are like a service company and a manufacturer. They supply parts to a number of private companies that create the small modular reactors, and that's a cool story. I like that story a lot. And it's got a secular tailwind, which is what's most important. You're not just, buying some, I don't know, so it's not a crowded trade, and demand's going to go on, I think, for decades, and it has to. We agree on that. The macros are strong, and the government has, embraced it. And so it's very exciting. Those are the nuclear stocks that I like. How does the Fed manipulate the markets? Well, I went through it. They, as I said, Ben Bernanke's thesis, grad's PhD thesis, was about what they call behavioral economics, whereby they can create a narrative by manipulating markets so that you don't panic, and they do it. I mean, that's what the Fed buying of treasuries is all about. That's what their buying of mortgage-backed securities is all about. It's propping up the market, okay, and keeping your mood ebullient. And I went through a chart of today's market action, which was early in the broadcast. If you didn't see it, it shows that the market was declining through the morning, and then at 11 o'clock, miraculously, it turned and rallied. I haven't seen it lately. But that was the moment that they were auctioning almost a record amount of 7-year treasury bills. I can go through it in detail, in further detail elsewhere. I can show you numerous examples. Oh, and I also showed how in the after hours market, the performance of the S&P is a lot better than during the day. And I think that's buying from authorities, maybe the Bank of Japan. I'm not kidding. And probably I would be doing it too, because of the risk of a market meltdown is so significant with the debt outstanding. DWXT, no, I think it's BWXT is the ticker for that cool nuclear-oriented company. How lean on cash should one be to prepare for the amount of inflation you see coming? Well, First off, if you're going to be, I would be careful being fully invested in the market right this minute. My partner, George Smith, who's a very judicious participant in these markets, started pulling cash off of his own account and then client accounts maybe a month or two ago, early this year. And so cash in that instance is good because he's got buying power and he's cautious and he wants to see the market's got some jitters right now. I know that you have noticed it, the rotations from growth to momentum to value to commodities and then out. And that nervousness is like chill bumps on a nervous animal in a way. I think that at signs of market tops and bottoms, you see a lot of behavior like that, volatility, if you will, not just in general, but among different subgroups in the market. And so I happen to believe that some cash is, probably smart right here because the market could be set up for a significant, I think this year we're going to see a major correction. I think the Fed's going to continue to try to prop it up, talk it up. And I think at some point they're going to struggle to do it. And I think it comes this year. I think we get through the stimulus fueled demand, pull forward of demand, right? The stimmy checks and so forth. And then we have a hangover. We have easy comparisons again, corporate, earnings comparisons and revenue comparisons against the downturn last year, this time. And then you get through that and then reality hits. And reality is that we've just burdened our economy and our society with so much debt that it's going to literally lead to a subpar GDP growth rate for a long time. GDP is a bad metric, by the way, because government spending is a tremendous part of GDP. So government spending, I would argue, is not productive. It's not production, it's spending. And to get the money to spend, the government has to tax production. It's a dead weight on production. If I was doing the math, I'm not a PhD, but if I were doing the math, I would take $1 of production and whatever amount of that dollar was government spending, and I would reduce GDP by that amount, not add that to GDP, if that makes sense. So I don't think you're with the dollar that you should be as worried about the decline of the dollar necessarily relative to high flying stocks and the risk in the markets. But I will tell you that the coming, if we do get a downturn like I'm expecting this year, the Fed's only going to jump in further and deeper and bigger and bigger and bigger. And they've already gone bigger than they've ever gone. They're going to get bigger, 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 bigger. I want to just let you know, I think that's going to happen this year. And that is bearish for the dollar. Precious metals, commodities, land, hard assets, real estate, they do well. They really do well in that kind of environment. And if you see the momentum of tech and whatever, SPACs, which is going to abate, and that SPAC door is closing, I think, as we speak. I call it speculation. All right, somebody doesn't agree with me. They're getting argumentative, and I can't even read it. All right, somebody's arguing with me. It's not a question. It's a comment that they think we're in a deflationary spiral, and I would disagree wholeheartedly, and I don't care. And we'll talk on the golf course. Why has gold struggled? Well, great question. Just hadn't caught a bid yet. It showed like it was going to perk up, but you know what? The momentum market resumed, and people are chasing profits and they're chasing SPACs, and a lot of the market's being fueled by this new money coming in from stimmy checks. These young people. That's a tremendous driver of this market momentum. By the way, RIAs are following it. RIAs like ourselves, not us. We're not doing it, I promise you. Our job is to preserve and grow wealth, not speculate with wealth. But that's George's job. My job is to speculate. But I think that gold will get a bid. I mean, look, we got too few goods here. We got too much money here. In the 70s, gold went from $30 an ounce to whatever, several thousand very quickly, while interest rates were rising significantly because you had the inflation equation in play. And I think it's coming this year to answer your question. I'm very patient with precious metals, very. And then I have a comment about FX, which is euro dollars. It's a great question. I think that all countries are devaluing their currencies, and so that's why gold may have an opportunity here to do well. I'm counting on it. The euro is, they announced a bond buying program. The ECB did just last week, and it led to a little increase in the dollar and a decline in gold prices and commodities generally, by the way. Now, all commodities had gotten caught up in the inflation, a whiff of inflation, except gold. You saw oil, copper, zinc, all those, even corn, soybeans. All the commodities were starting to really show some strength, and they've rolled over. I think before gold, they've gone to those flow commodities. Gold is a store of value. By the way, it's a store commodity. Flow commodities are commodities that you actually use. Okay, so I think I've got more cute questions. Oh, inflation rate. What do I expect the inflation rate to be by the end of the year? I think the inflation rate, by the way, I cannot stand CPI. I don't think it's a true measure. And I'll go through it in 1 second. But 5%, I wouldn't be surprised to see 5%. That would be a shocker, but maybe 4 is a better number. CPI is manipulated, okay? CPI used to be a basket of goods, okay? Let's call it 20 goods. Maybe it was a pound of hamburger meat, shoes, lumber, 20 items, call it, some amount of items. And they would measure what the price was per each item year over year, simple as that. The same weight, quantity of the same good. Now they adjust. So if beef prices rise significantly, they're going to assume that you trade down to chicken. So they will actually adjust down the price of a pound of beef, assuming that you substitute your beef purchases for chicken. Well, that's a different measure of CPI. It dampens CPI. It is not a true measure of price inflation. You get it? Here's another one. 29% of CPI is owner's equivalent rent. I've been through this. It's a survey they call homeowners like me or my dear wife. And as intelligent as we are, which is arguable with me, but not with her, they'll call them up and ask them, what do you think you could rent your home for? Now, these are homeowners, not renters. I'm not a landlord. I'm not in that business. What could you rent your house for this month versus last month versus last year? So how scientific am I going to be in that answer? How scientific would you be in that answer? Well, if I'm feeling particularly bullish, which I am about my home price, I might answer my mortgage plus a couple $100. The point is that's not scientific. In fact, it's a joke, a farce. And the fact that people react to it, to me, is disappointing. It's like China's GDP growth rate of 6% through thick and thin. It's bogus, gang. Don't believe it. When I say that things are manipulated, that's how they're manipulated, my opinion. Anyway, CPI, bogus number. They'll probably try to control it. I know they will. 4% could be the number. Agriculture commodities, somebody's asking how I play them. They were rallying like crazy and they have pulled back. I think I would wait for them to pull back and see where they settle. China is a vociferous buyer of corn and soybeans, as you may know. A lot of it depends on the weather. There's been some rain in the Midwest. I'd monitor the rain in the Midwest and find a buying point. But I would own commodities, no doubt about it. Copper is going to be a beauty, zinc as well, silver as well, because of the growing number of electric vehicles and batteries, and the demand is just surging for these metals. So I think that they're a good long-term holding. And remember, when this market quits, when SPACs quit, when you no longer have 10 SPACs a day, and when a company misses numbers and the stock goes up 10%, when those days are over, and they are nearing an end now, that's when you'll see people rotate back into value, which has taken a beating the last week, small caps and also commodity related investments. So I don't know precisely when to get into agriculture commodities, but there will be a time. And I want to thank you for attending. You know how to reach us for anything. Personal advice, and we like that the best. Spiritual advice, we're going to be lacking there. Investment advice, go to George, and I'll watch and learn. Gosh, I hope you have a great rest of the week and weekend. And I think the Sweet 16 starts, which I'm very excited about. All right. Bye-bye, everybody.